Welcome. We're pleased to have you join us today. My name is Norm Boone, and I'm the founder and president of Mosaic Financial Partners. Today we're going to be talking about alternative investment strategies, approaches that are neither stocks, bonds, nor cash. Alternatives make up a significant portion of our clients' portfolios precisely because they work differently than stocks, bonds, and cash. In other words, they help enhance the diversification of a portfolio. Because alternatives are a new way for most people to invest and involve a lot of approaches with which people are less familiar, we thought it would be important to spend some time helping you understand what alternatives are, why and how they get used in a portfolio. Our presenter today is one of Mosaic's key employees, David W. Cowles. Dave joined Mosaic in 1997 and serves as the Mosaic Director of Investments. He chairs the Mosaic Investment Committee and oversees all investment research, trading activity, and portfolio management. Dave is a CPA by training, having spent several years at Coopers & Lybrand. He also spent 9 years in private industry in senior financial management positions. Along with his CPA, Dave is a certified financial planner and holds a master's in personal financial planning. Dave has helped Mosaic stay at the forefront of the investment industry. While never first, Mosaic has almost always spotted trends early because of Dave's work, which has allowed us to benefit our clients by being early adopters of major investment trends, including early and consistent use of real estate investment trusts as a portfolio enhancement, early willingness to be well-exposed to international funding, early use of exchange-traded funds as an efficient and tax-efficient way to invest, early use of fundamental indexes, which are now being called smart beta funds, and early use of alternatives as a key part of client portfolios. Dave, thank you for joining us today to share some of your wisdom.
Thank you, Norm. Let's begin with the end in mind. And this is what we're going to want to communicate at the end of this presentation. That alternative investments can improve a portfolio by reducing risk or volatility, increasing returns, or both. So if we've helped illustrate that through this presentation, we've been successful. So let's talk about how we're going to get there. So we'll start with a definition of what are alternatives, why you would want to use alternatives, how do you gain access to alternatives, and where should they go in a portfolio. Let's start with a definition. We define alternatives as an asset class or an investment strategy whose returns are not closely tied to the returns from traditional stocks and bonds, i.e. they have low correlation. So there's a technical term that we're going to be using in this presentation, so let's take a closer look at what correlation means. So correlation is a statistic that refers to the degree to which two investments move together. They range from a high of 1 to a low of -1. So highly correlated investments, those that are close to +1, usually move in the same direction. So if the stock market is up, an asset that is highly correlated to the stock market would also be up. If the stock market is down, you would expect a highly correlated investment to also be down. Now, investments with low correlation, those near zero, they move independently of each other. And negatively correlated investments, which are pretty rare, they would move in exact opposite directions. Now, why would you want to use alternatives? Again, because they enhance returns and or lower portfolio risk. They can improve risk-adjusted returns, and that's something referred to as a Sharpe Ratio. It's a technical term on how much return are you getting for the amount of risk you're taking. And then finally, portfolios using alternatives may be less volatile during difficult market environments. And we're going to go through a little bit later in the presentation how alternatives have done in the last 2 market crashes. And you'll see how they do differently than stocks. Now, traditionally, investors have gained access to alternatives through hedge funds. Now, a hedge fund is simply refers to a legal structure, typically a private limited partnership that invests in alternatives. They'll often describe a hedge fund as a fund that's seeking an absolute return, which means they want to make money regardless of the direction of the stock market. Now, they were called a hedge fund because the original intent was to hedge against a decline in the stock market. Today, many hedge funds are really misnamed, as they're not even trying to hedge out market risk, but the name is kind of stuck and refers to any kind of private investment that's following these alternative type strategies. Now, unfortunately, hedge funds have a lot of serious drawbacks. First of all, they're unregulated. They're generally illiquid. It may be difficult for a hedge fund investor to get your money out when you want to. They're generally only open to qualified investors, typically those with net worths greater than $1.5 million. They often come with very high costs. So a typical hedge fund arrangement might be to charge a fee, an ongoing management fee of 2%, plus 20% of the profits the fund makes above some threshold target. That's just kind of a typical fee arrangement. Many hedge funds charge even more than that. Hedge funds generally have a lack of transparency. As an investor in a hedge fund, you don't really know what the fund holds. The hedge fund manager will say, oh, well, you know, that's all proprietary and we can't disclose our secrets. And so if you like investing that way, that's fine, I guess, but you really don't know what you're invested in. And then finally, the hedge fund industry has unreliable performance data. You might read an article that maybe hedge funds have averaged 15% returns for the last 20 years. And the problem with that is there might be survivorship bias in the data. For example, hedge funds that maybe failed and went out of business during that 20-year period may not be included in the calculation. Also, hedge funds are subject to self-reporting. So if you're a hedge fund manager and you have a hedge fund that's done well, you, of course, will want to brag about it and get included in those statistics. But if your hedge fund did poorly, you're not going to be inclined to want to brag about that, so you simply will choose not to tell anybody about it. So there's self-reporting problems in the data. Fortunately, more recently, we have this concept called liquid alternatives. And what that refers to is that some hedge fund strategies are now available in a mutual fund or an exchange-traded fund structure. Those vehicles are regulated by the SEC. They do provide periodic shareholder reports and are subject to annual audits to confirm they actually own what they say they own. Mutual funds and ETFs have daily pricing and therefore daily liquidity. You can get out of a mutual fund or ETF anytime you want. Obviously, these come with much lower costs. Typically, mutual funds do not have any type of performance fee. I checked Morningstar's directory, and in the broad category of alternative mutual funds, there were over 2,000 currently listed. That's grown immensely over the last few years. Now, here's some examples of liquid alternatives. These are all investment strategies that we would say meet our definition of alternative that are available in a liquid mutual fund or ETF format. And we'll talk about each one of these in a little bit more depth in a moment, but let's just run through them real quickly here. We have real estate, commodities, emerging market debt and currency, managed futures, merger arbitrage, energy infrastructure, timber, and business development companies. Those are the alternatives that we use in our firm. Other firms may use some of these other strategies that are out there, such as long short, that can be equity or credit, market neutral, net short, and global macro. We've looked at some of those and have decided to pass at this time, but they should at least be included in the list of liquid alternatives. Let's take a look at some of these in a little bit more depth. Now, real estate refers to real estate investment trusts. These were created by Congress and in order to encourage investment in real estate. And REITs will invest in real estate buildings. So they're going to make their money from rents, right? So they're going to own offices, apartments, shopping malls, hotels, warehouses, those types of things. Now, a REIT trades on a stock exchange just like any other stock. So therefore, you've taken a very illiquid asset, real estate, and converted it to a liquid form. So we've taken something that's very illiquid, and now we can trade it and see prices go up and down every day. Now, I mentioned that Congress created REITs, and when they did, they gave it a special tax benefit. There are no entity-level taxes, no corporate taxes, if you will, on a REIT, so long as they distribute the vast majority of their earnings to their shareholders, and the shareholders have to pay the tax, of course. But as a result, REITs have a very high yield compared to other stocks. Now, REITs, the concept of REITs has been around in the U.S. for quite a while, and many foreign countries are seeing the benefits, and now they're also available overseas. Now, on each of these charts, I'm going to be talking about drivers, and what I mean by drivers are, what's going to impact the return of this alternative strategy. Ideally, the drivers, the economic things that impact this alternative strategy might be slightly different than those that impact regular stocks, because that's what we're trying to do is get the diversification here. So in the case of real estate, they certainly are subject to the economic cycle. Interest rates impact REITs because they have to borrow money for their mortgages. So the cost of, if rates go up, it's more expensive to finance their building purchases. And local demand. We've all heard the phrase location, location, location as it refers to real estate, and that certainly applies to REITs. Next one is commodities. Commodities is a broad subject, but here you're talking about generally tangible things. They cover a broad range of things. So let's look at energy. An example of that would be oil or natural gas. We have industrial metals. An example there would be something like copper. Precious metals, obviously gold or silver. Agriculture could be cotton, livestock. We hear the phrase pork bellies. So those are examples of what commodities are. Now, a commodity fund is going to invest in those commodities, but they're not going to take direct ownership. Your fund is not going to have a warehouse someplace full of oil barrels. Instead, commodity funds are going to invest in commodity futures contracts. Now, a futures contract is simply an agreement to purchase a commodity at some future date. And let me give you an example of why the world needs futures contracts. Let's say you're a farmer and you're planting your corn right now, and I don't know how long corn takes to harvest, but let's say that's 6 months. So 6 months from now, you're going to be selling your corn. But you, of course, don't know what you're going to get 6 months from now, and maybe you need to borrow money to buy a new tractor. So the farmer can agree to sell or deliver his or her corn 6 months out, and somebody will buy the right to take that corn today at, essentially today's price of corn. So that gives the farmer the ability to lock in how much the farmer's going to get in 6 months when they sell that corn. Now, well, okay, that's good for the farmer, but who would want to buy that deal? Who would want to pay for corn 6 months from now? Well, maybe General Mills or a company that makes cereal or needs corn in its production. They'd want to lock in their cost of production so they know how much they should be pricing their product 6 months from now. So they can lock in their cost today by agreeing to buy that farmer's corn 6 months from now. So that's how the futures contracts work in the real world. And the funds that are investing in these futures contracts are going to get their exposure to energy, metals, agriculture, and livestock by owning futures contracts, again, not owning the actual commodity. So the drivers in the commodity fund are going to be inflation, commodity, the supply and demand of that actual commodity, and interest rates get involved to some extent because when you're trading commodity futures, you actually put up a small amount and the rest of it is invested in collateral, so you get a return on that. Emerging market debt refers to government bonds that are issued by emerging market countries, such as China, Brazil, India. Traditionally, this debt has been issued in U.S. dollars, so you're not really taking any currency risk here. And interestingly, the debt issued by these emerging market countries, it has a very low correlation, doesn't move the same as the bond market in the U.S. So this gives us some diversification benefits, just comparing emerging market bonds to U.S. bonds. The drivers here influencing this alternative strategy are going to be inflation and interest rates, obviously, and also the credit spreads or the perceived risk of the issuer, which in this case is the emerging market country. Now, similarly, we can also invest in currencies. And so if you're going to invest in emerging market currency, now you are taking currency risk. and you're going to invest in very short-term debt or currency forward contracts. Think of this as essentially like a one-year CD denominated in, the emerging markets foreign currency. The theory of this investment is that the emerging market currencies should strengthen relative to the dollar over time as these countries become more developed, as their middle class, as the people move more into the middle class, they become more like a developed nation. The currency is deemed less risky and should strengthen. So that's the theory, and that may take years. But as that's happening, in the meantime, the interest rate you're getting from investing in the very short term is generally more than you can get on a short-term investment in the U.S. So the drivers of the return on this strategy is going to be the economic stability and the monetary policy of that emerging market country. And obviously, interest rates get involved as well. Now, managed futures. Unlike a commodity fund, and we've talked about commodity funds want to own exposure to the various types of commodities, a managed future is also going to have some exposure to commodities, but it's going to have it in what we call long or short. So it's going to buy futures contracts, where it can take that corn delivery back in my earlier example, but it may also sell futures contracts on the hope that the price will go down and it will buy the contract back later after the price has dropped. So we call that going long, owning it, or going short, where you're kind of betting against the contract. And what managed futures contracts generally, or funds are generally doing, is going to buy a contract of a commodity if the price trend is going up, and they're going to sell a contract, a futures contract, if the price trend is going down. And this applies not just to the commodities we mentioned before, but you can also have futures contracts on equity indexes, fixed income products, currencies, and the commodities we talked about earlier. The whole reason this investment even is around is that research shows that price trends, whether up or down, do tend to persist. So if, let's just say copper, if the price of copper has been going up for the last 5 months, so each month it's a little bit more expensive than it was before, research has shown that more likely than not, in month number 6, copper will also be a little bit higher than it was in month number 5. So a managed futures fund might try to buy a copper contract in that example on the anticipation it's going to be worth more later. And it works flip side on some other futures contract that's going down, they would sell that short. So that's how they're hoping to make their money. Now, what influences that is how long those pricing trends continue. So I gave an example of a 5-month trend, and we assumed it would continue into month 6. But if a trend only lasts a couple months and then the price goes the other way, that trend's very difficult for these funds to take advantage of. So the length of the trends will impact, and then the volatility of the underlying contracts also impact their profitability. Merger arbitrage. What these funds are pretty specialized. What they do is they invest in an announced merger or acquisition. They're not speculating that some company may get acquired down the road. They're waiting for the announcement to be made. And what's the most recent announcement? What do we have? We have AT&T is going to buy DirecTV. So a merger fund might be looking into that deal and deciding if they want to participate and invest in that. And so how would they invest in that? If they try to capture the small spread, the small difference between the merger price and the current market price. And if they think that that's worth investing in, there's going to be a small difference there, they would buy the target company, in my example, DirecTV, and short the acquirer stock, AT&T, and that by doing so, you effectively remove the risk of the stock market. So and maybe it's going to take, I don't know what the deal is, maybe it's going to take 3 months for that deal to close. So a merger fund would take this kind of investment, and they don't really care if the market goes up or down during that 3 months. They're just going to make money if the deal actually closes. They'll lose money if the deal falls apart. If the Justice Department says they don't want this deal to go through, the deal may fall apart, and then they would lose money. So obviously the most important driver for merger arbitrage is the completion of the deal. Other things that impact profitability of this strategy is simply the level of merger activity. Okay, So if there's very few mergers being announced, these funds may have trouble finding attractive deals because of arbitrage competition. There's other funds doing essentially the same thing they're trying to do, and if there's not much merger activity deals going on, the spreads may become unattractive and just not worth the risk. Interest rates also get involved here because we do have some shorting, and when you short, there's a cost to pay for that borrowing. Energy infrastructure. This refers to publicly traded limited partnerships that own pipelines or storage facilities. These companies charge for transportation and storage services. So they're transporting, oil through a pipeline or maybe natural gas, but they don't really care what the price of oil or natural gas is. They're getting paid for their services only. And in fact, these like pipeline costs are actually regulated. They typically get an inflation-like increase every year. So you can see how this investment is indifferent to the price of oil, and because they're partnerships, similar to REITs, there are no entity-level taxes. Therefore, they pay high yield, high distribution. So the drivers here are going to be the supply and demand for the infrastructure, the pipelines, if you will, government regulation and approvals, as we've all heard about the Keystone Pipeline. That would be a pipeline that might belong to an energy infrastructure MLP. And then interest rates on competing investments. Timber REITs are a special kind of real estate investment trust. The regular REITs we talked about earlier own buildings and make money from rents, right? Timber REITs have a large amount of land, and what they do with that land is they grow and harvest trees. Trees are sold to lumber mills or paper producers. Now, just like the other kind of REITs, these timber REITs don't have any entity taxes so long as they distribute most of their earnings. But unlike regular real estate REITs, the yield that they do distribute to their shareholders is taxed as a capital gain. So it's much lower tax rate. And the reason it's taxed as a capital gain is that what timber REITs make their money from is growing an asset, and a tree in this case, and selling it. So in the eyes of the IRS, that is a capital asset and therefore subject to capital gain taxation. So timber REITs have high yields that are attractively taxed compared to the regular real estate REITs have high yields, but those dividends are taxed as ordinary income. And then finally, the other thing that's very unique about timber REITs is timber REITs are absolutely subject to the economic cycle. So if the economy is hurting and home builders are not building very many homes, the demand for lumber is real low. If you were going to sell your trees right now, you'd get a very low price for them. So what do you do if you're a timber REIT? You simply don't cut the tree. So what happens if you don't cut that tree? Well, it grows bigger. So the tree, meanwhile, is growing bigger while you're waiting for the economy to get better. So let's say the economy is in the dumps right now. You wait a year or two, and 2 years from now the economy is booming again. You then cut your trees. Not only are you going to get a higher price for your tree than you would have if you sold it today, but the tree itself is bigger and thus more valuable, has more wood in it than it did today. So that's an interesting way of mitigating some of the economic volatility. But most companies can't say that if they don't sell their inventory, it's going to get more valuable. Okay, so the drivers for timber REITs are going to be housing construction demand. Emerging markets get in here. China and even developed markets like Japan don't have a lot of forests, and so they have to import a lot of their wood, so that impacts the demand for lumber. When you're buying REITs, there's actually only 4 timber REITs in the United States. So you're going to take some individual company risk because you can't be completely diversified here, and there's always a risk of a wildfire on your company's, your REIT's land, or you can even have beetle infestations that basically destroys the trees. Big problem of that up in Canada right now. And so there are risks you're taking here, and that's why you certainly want to be diversified wherever you can be. Finally, business development companies. these are actually kind of similar to a venture capital or private equity firm, but they're publicly traded. So what a business development company does is it provides funding for small companies, usually via a secured loan. So think of this as kind of high-risk lending to companies that are too small to issue their own bonds and that kind of thing. But because it's high risk, the returns on these loans are quite attractive. And again, Congress, wanting to encourage small companies and their need for financing, gave business development companies a tax advantage. There are no entity-level taxes on BDCs, and once again, these have very high yields as a result. So here, the drivers of these companies are going to be tied to the economic growth of the country because they're impacting the small companies and interest rates on competitive products and whatnot. Okay, let's take a look at some of the historical data associated with these alternatives we've been talking about. First, let me introduce the time period we're looking at. I'm able to take these return series back to early 1990. That's essentially the earliest date that some of these alternatives have data. Business development companies may not have existed prior to those dates. For reasons like that, that's about as far back as we can carry the data. And going across the top, the columns we have here are the annual return. This is the historical return over this time period, which is just over 24 years. This is the return they've made. One thing I like to look at is the percentage of time, in this case, the percentage of the number of months here that actually lost money. So here we see what percentage they lost. And just so you can have something to compare with, we put stocks and bonds down here. So here's U.S. stocks. They lost money about 35% of the time historically. So approximately 1/3 of the time the stock market will lose money, 2/3 of the time it goes up. Bonds lost a little bit less, but you can see that the losses on these alternatives are essentially in the same ballpark, if you will, of the loss frequency on stocks. So that's kind of interesting. And here's the correlation figure we've been talking about. Remember, smaller correlation is better because that means that asset has a better fit in a portfolio. So the highest one on here is real estate at about 60. So that anything 60 or less, let's say, is going to help the portfolio. There's no hard and fast cutoff. 65 would also help, but just not as much. So the other alternatives shown here have fairly low correlations, which is good. You'll see the correlation to the stock market is 1. That's what we mean. The stock market has a perfect correlation to itself, and anything less than 1 is beneficial, but you want to get as low as you can. Managed futures here has a negative correlation of 0.18. Negative is great. If you can make a positive return in the long run and have a negative correlation, that's perfect. Now, 0.18 is pretty close to 0. It's much closer to 0 than -1, which would be perfectly negatively correlated. So I'm going to basically consider managed futures as totally uncorrelated, but not negatively correlated. The rest of these have slight positive correlation, but that's more common. Now, when we look at the returns, it's interesting to note that during this 24-year period, the return on U.S. bonds about 6.6%, okay? One thing to keep in mind is during the last 24 years, in general, interest rates have been falling. So falling interest rates help bond market returns. Right now rates are pretty darn low, and if the Fed starts tightening as the economy improves, we would not expect future returns on bonds to be anywhere near 6.6%. But this is what they've historically made over the last 24 years. Look at the returns of the alternatives we're talking about here. All but one of these alternatives outperformed bonds during this 24-year period. So of the 9 we've shown here, 8 of them outperform bonds. Okay, let's compare to stocks. On the stock side, 5 of these different alternatives had higher returns than 9.7%, and you'll recall with fairly similar risk characteristics. So that's an attractive diversifier there, especially if you can do that with low correlations. Okay, this I showed you before. That was a table of the data. Now here's a more visual way to look at the data. And we call this format a risk-return scatter chart. And so the way to read these charts is on the left we have the rate of return. This is the annual return, again, over the last 24-plus year period, ranging from 0 to 20%. And we have risk, or standard deviation. This is the volatility of the investment on the bottom scale. And so for comparisons, we put the S&P 500, the U.S. stock market here, in the crosshairs. And so you can see that stocks here is at 9.7%, close to 10% return. And risk is around a little more than 15. So you can now visually see of each one of the alternative strategies how they compare on a risk and return basis to the S&P 500. So these strategies up here above this line, that means they made a higher return than the S&P, and this strategies up here, about 4 of them, made a smaller return. On looking on the risk side, anything to the right of this line of the S&P 500, those are riskier alternatives. And over the left, these are less risky. So the riskiest alternative strategy on this chart is the business development companies. That's the venture capital type approach that's liquid. And the lowest risk is over here. That's merger arbitrage. On the return side, the highest return we had over the 24-year period is the energy infrastructure. That's the pipeline business. And the lowest return was commodities. But even at that, it's making, a nice 5.75% return. So that shows you how these have done over the last 24 years, let's say. Now, as promised, I wanted to show you how alternatives have done over the last 2 bear markets. So the first bear market we have was the technology bust. If you remember back in the late 90s, tech stocks were on fire. Anything with .com in its name was skyrocketing on the stock market. And that was doing great until all good things must come to an end. And so in September of 2000 to October of 2002, about 2-year period here, the stock market crashed. Tech stocks got absolutely clobbered and took most of regular stocks down with them. So during this time period, the S&P 500 on an annualized basis lost 26.3% negative return during this bear market. But look at the alternatives. Every single one of them had better returns than the S&P 500. So during this bear market, all of these alternative strategies did better. So during this bear market, had you allocated some of what you used to put in stocks to alternatives, you would have definitely come out ahead. Now let's look at 0. Here's the 0 return line. So on an annualized basis, anything above this 0 line made money. And so you can see 2 of our alternatives lost money, but not as much as the S&P. The rest of the alternatives, this guy's essentially break even, but the rest of these here made money during the technology bust, okay? So during this time period, MLPs, the pipelines, 22.8% return, while the stock market is getting hammered with a minus 26 return. The other one that did well is managed futures, 13.2% return, again, during the exact same time period that the S&P 500 is doing very poorly. Okay, that was the technology bust. What about the more recent crash we had, the financial crisis? Remember back in 2007 to 2009? This is when Lehman Brothers went bankrupt. So anything that has anything to do with finance is getting absolutely destroyed, and the whole stock market is coming down with it at the same time. So during this time period, how did the S&P do? Negative 43% annualized. Okay, that's even worse than the tech bubble crash. Negative 43%, and during this time period, virtually everything, every traditional investment was going down. And so during the financial crisis, 2 of the alternatives that are more finance-oriented, which is business development companies, they lend like a bank to those smaller companies. They lost money, in fact, lost more than the S&P 500 did, as did real estate. But the other 7 strategies during this bear market did better than the S&P 500, okay? And most of them lost money because here's 0. So all of these are losing money, have negative returns during this time period. but substantially better than what the S&P 500 did. And managed futures, once again, during this bear market, managed futures actually made money at an annualized return of 11.9%, while the S&P 500 lost 43. So these two charts really show how alternatives can benefit during a market disruption. Because if they're uncorrelated, they don't really care if the S&P 500 is going up or down. They're going to do their own thing. They may lose money, but you can see the benefit here. Here's another way. I just wanted to show another way to look at alternatives, and I could have done this for every alternative, but I don't want to bore you with all that. But what this is called is a rolling return chart. And so what this chart does is it looks at 36-month periods, and so every dot on here on the black line is a 36-month period of looking backwards to say what was your annual return, what was your holding period return if you owned stocks on this date, looking back 36 months. Then the next bullet on the chart would be dropping off the oldest month and replacing it with one new month and recalculating the average. So these rolling return charts are helpful in seeing trends. So here you can see the volatility S&P 500. So here is the trend that's getting impacted by the tech bubble. So you can see that the trend is going way down. Okay, but these are 3-year holding periods. So I just mentioned during the tech bubble it lost, what, 24% or something. During a 3-year holding period, it only got as bad as losing 15, let's say. But you can see the trend, and then it comes back up, and then here's the financial crisis trend, and then more recently the stock market's been doing very well, and so we're doing here. Now the other one I graphed on here was, just for an example, was merger arbitrage. Merger arbitrage is one of the more conservative strategies, and you can see why. You can see that its volatility on a trend basis is not flying all over the place. So it's generally hanging in here between, I don't know, 0 and 10% more recently and a little bit higher earlier is what managed futures have been, merger arbitrage has been doing. And one of the things that this can show you is that if you look at 0 right here, the 0 return line comes across here. And interestingly, if you held, historically, merger arbitrage for a 3-year period, you never lost money. So there's no point where the 3-year dips below the 0 line. So as a rule, merger arbitrage is considered a fairly conservative alternative strategy, and therefore, for example, might be a place if you wanted to reallocate some of your bonds, then you could put part of that in merger arbitrage. So one of the more conservative strategies. There's other alternative strategies that are much more volatile, and that maybe is where stocks would get involved. So that leads us to our next set of questions. So how much should you allocate to alternatives? And like we just said, do you want to take it from stocks or bonds? And does this really help? I mean, does this help a portfolio? Well, let's try to now focus at the portfolio level. So what we have is here is two pie charts, and comparing the two pie charts. The first pie chart is your very basic 60% stocks, 40% bonds. So we have 60% in U.S. stocks, 40% in U.S. bonds. So this is your traditional diversified U.S. portfolio. What we've done is taken this portfolio and carved out room to put 20% in the 9 alternatives. And just to keep it real simple, and what we did here is we equal weight those 9. So each 9 works out to about 2.2% in each of the 9 strategies. And so if you carve out the 20% here, we took it proportionately from stocks and bonds. So instead of being 60% in stocks like we were before, stocks is now 48%. U.S. bonds dropped from 40 to 32%. And then we have the 9 strategies, alternative strategies to get to our 100. So and this is just an equal weight example. What we do is have different weights, but I wanted to just keep it simple for this presentation. So here what we have is back to our risk-return scatter chart, but instead of looking at individual alternatives, we're now looking at portfolios. So this is the whole package, if you will. So the first line, the first series here, the solid symbols, these are the portfolios with no alternatives. So the first one here, this is your 60-40. So this is 60% stocks, 40% bonds, just like we saw in our pie chart. And the other bullets on here are proportionately increasing a stock. So this is 60% stocks, 70% stocks, 80% stocks, and then going the other way, 50% and 40% with the other part, and bonds, obviously. And so this is a traditional, you can call this an efficient frontier, if you will, where depending on your risk tolerance, you might like one portfolio over the other, because as you go from 60% stocks to 70, you increase your risk, but you're increasing your return, because you can see that the return gets higher as you add more and more stocks, right? So the 80% stock portfolio here has a high return, historical return of about 9.5%, where the one with 60% stocks was making less than 9% historically. Okay, so that's the traditional way. Now what we did with the open symbols is took those exact same portfolios and carved out 20% for alternatives, taking proportionately from stocks and bonds. And you can see in every case, the portfolios with alternatives are making higher returns, okay? And in most cases, they're actually doing so with less risk. Let's look at our 80% stock, 20% bond portfolio. When we add the alternatives, we increase the return because we're moving up. We go from that 9.5 to something over 10%. Okay, so that's a nice return at the portfolio level. There's a nice increase in return. But look, we also decreased risk. This portfolio used to have risk over here a little bit more than 12, and now it's getting pretty close to 11. So the risk went down because we moved it to the left, and the return went up. So this portfolio is, we use the phrase, is clearly superior to the portfolio without alternatives. Higher returns and lower risk. That's great. Every one of these is in the same situation. Everyone has higher returns, and all but the bond-heavy 40% equity model actually have lower risk at the same time. This one has slightly higher risk, but in all cases, higher returns. So in summary, what we want to show is that alternatives help diversify a portfolio and therefore help increase return, reduce risk, whereas we just saw quite possibly do both. And the liquid alternatives that are now available resolve many of the issues that we've seen with traditional private hedge funds. So all the disadvantages of the way we used to have to access these alternative strategies have generally gone away when we've switched to liquid alternatives. Now here's all the legalese our compliance department requires us to show. And what I've also done here is I've listed the source of the return data you've seen in the tables and in the charts of each of the indices. So if you want to know where I'm getting that information, that's where that's coming from. And with that, Norm, I think we can turn it over to questions.
So that was great. We do have a few questions, and I want to remind the audience that if you have questions on the right-hand side in the chat box there, you should be able to type in your questions, and we'll try to get answered, assuming that we don't have too many. Dave, just to start off with, a relatively simple one, I hope. If you were going to just pick one of these alternative strategies, which one would you pick?
Interesting question, Norm. Quite frankly, I wouldn't want to go with just one of these strategies. Each of the alternatives we've been talking about here has its own risk factors. But in a diversified group, you reduce the impact of any one strategy having a bad run. They really do work best as a team.
Okay. So one of the audience members, suggests that the merger arbitrage and the managed futures, both are using arbitrage to one sense or another. And when you use arbitrage, the more people that get into that game, the less advantage there would seem to be to making use of that strategy. So as more and more people discover these opportunities, the opportunity for profit is going to decrease. Would you care to comment on that?
I think to some extent that's true. Here's going back to the rolling returns of the merger arbitrage strategy. And you can see that back in the late 90s, the return that we were getting from the arbitrage strategy was, in the, 10 to 20% range. Between 2000 and more recently, we're kind of in the 5 to 10% range. And then very recently, say from 2008 to date, we're in the 0 to 5% range. So I think competition will absolutely impact the profitability of what's available. So we have to watch this, but I think it's still a value. It still adds value to a portfolio. Maybe the value is not as good as if we were doing this presentation 20 years ago.
Thank you. A number of the alternatives that you've talked about today haven't been too exciting the last 2 or 3 years. What keeps you coming back and believing in them?
Okay. Well, our investment philosophy is really built around diversification. At any given time, in fact, almost by definition, in a well-diversified portfolio of stocks, bonds, and alternatives, some investments somewhere in the portfolio will be losing money over the last couple of years. This is to be expected and should not be a concern. Ultimately, we expect every component in our portfolios to add value over the long term. But that doesn't mean over any short period of time that's going to be the case. For example, if you look at the alternative strategies that have losses over the most recent 3-year period, almost all of those strategies show attractive returns over the last 5-year period. So the time period is you got to be looking longer term here. The alternatives we're using were selected for their long-term strategic benefit. So if the reason for adding the alternative to the portfolio has not changed, there's no reason to drop it.
Okay. So do you have any expectations with regards to, for example, the merger arbitrage chart that you showed, that lately has been, fairly low in terms of returns, but used to be pretty attractive? Do you have any expectations about the future?
Well, remember when we were talking about merger arbitrage, one of the drivers was the level of merger activity. So the more merger activity is going on in the economy, the more opportunity there is for merger funds to make a profit. Okay, so one of the trends, I don't have the exact stats of how much activity there has or has not been, but that certainly is a driver. So if you want to make money in this field, you would hope that the activity would pick up. In other words, more AT&T, DirecTV type deals.
Okay, thank you. If you look at, you talked about 2 different kinds of REITs. One of them was the timber REIT, and the other one is a more broadly diversified REIT. With the timber REIT having higher returns and a lower correlation, the question from the audience is, why would you want to use both? Why wouldn't you just use the timber?
Okay, good question. I think they're really in entirely different asset classes, if you will. They're both called REITs. They both have the same congressional tax advantage of the no corporate taxes and things like that. But they're really dealing with entirely different segments of the economy. So the timber REITs are driven by the demand for timber, whereas the traditional real estate REITs are driven by the demand, the demand for their type of real estate. So sometimes, we're talking about buildings, offices, apartments, shopping malls, hotels, warehouses. Most of the REITs specialize. So you might have a REIT that specializes in shopping malls, or a different REIT that specializes in warehouses. And so even these different types of buildings will have different situations where one's doing well and another one might not be. So I think they're really 2 different things. It may be that the timber REITs have done better recently, but I certainly don't want to write off regular real estate.
I might say that we started in the 90s with REITs and the regular, more diversified REITs, and they certainly improved our portfolios by holding them.
Absolutely.
A lot of people believe that interest rates, are likely to go up here. What are your thoughts with regards to the impact of rising interest rates on these alternative strategies?
Okay. Well, first of all, if yields on competing investments like bonds go up, then the market demand for high-yielding alternatives may temporarily be impacted. but let's keep in mind that the Federal Reserve should only raise interest rates if the economy is doing well. If that is the case, then yield-sensitive alternatives such as real estate, timber, business development companies should also benefit from a strong economy. So, while there is some interest rate risk, if you will, as there is in bonds, I think the risk is different, and it will impact these alternatives differently. And so again, diversify. I think that actually using a well-diversified group of alternatives alongside bonds is one of the best ways to diversify the chance of interest rates going up.
Okay. So for bonds, foreign bonds, or more specifically emerging market bonds, one of the audience members says, and I think accurately, that with some confidence that next 25 years versus the last 25 years, interest rates and returns are likely to be lower just because of that change in interest rates and some of the other conditions that apply there. Looking at the other strategies, are there other kind of drivers that you see that you would identify that suggest kind of a change in overall conditions similar to that having to do with bonds?
Well, the emerging market debt, as you mentioned, is subject to interest rate environment and those types of things. But as I mentioned earlier, it does have a low correlation to U.S. debt. So unlike even diversifying to German bonds, diversifying to emerging market bonds gives much more diversification benefit. The returns that we see here, like the return on emerging market debt at 12%, I don't want to imply that that's what I expect to happen over the next 24 years. Certainly, as I've already mentioned, we don't expect U.S. bonds to earn near 6.6% over the coming years. So I think I think this is true with stocks, quite frankly. I think our return expectations need to be lowered. What we expect to make in stocks, bonds, and alternatives perhaps needs to be lower than what we've seen historically. But the theory of how we want to build a diversified portfolio still applies.
Okay. Thank you. I think I think we're pretty well through with our questions here. Any other kind of parting words that you want to add?
Well, again, going back to what we were hoping to accomplish is that I want to demystify alternatives. We're using a pretty broad group of alternatives, and so Reefs have been around a long time. So it doesn't have to be very mysterious, but I just think the whole theme here is that any way you can help diversify a portfolio by adding an asset that has a reasonable expectation of a nice return, and if that's low correlated to what's already in the portfolio, you're going to be improving that portfolio, and that's ultimately what we're trying to do here.
Perfect. Good summary. Thank you. So our next webinar will be next month on Thursday, June 19th, and it will be at 11 o'clock Pacific time. The topic will be getting married, issues that need to be considered by members of the LGBT community, and will be presented by our own Steve Branton. We hope you'll be able to join us, and thank you all for joining us today, and we look forward to talking to you in the future. And certainly if you have any questions, let us know, and Dave or someone here will be happy to respond to you. Thank you very much.